All right, we just looked at all the areas of return when it comes to performance evaluation. Now it's important to just understand, well, that's all great, but how do I measure this? So I ran through a couple points. I'm hoping I can make this make sense. But first off is you choose a benchmark. And what that means is you have to have something like a long-term benchmark, an index like an S&P 500 or a world index like the MSCI World, something like that that you can compare your investments to. That there's a bunch of rules on how to set it, but I think a lot of people know what the S&P 500 is. You set that and it's something you can compare to. Now, something that's really important is that you need to understand that you can and compare it against an appropriate time period as well. The benchmark needs to be appropriate, but the time period needs to be appropriate as well. When I say appropriate benchmark, I mean, you can't, if you have a bunch of money that's going to be short-term investments that are held in CDs, you want to get those CDs out of there. Like you don't want to, like that's going to take a drag on your portfolio, but it's important because that money is going for short-term and stocks are not appropriate. So we want to have a long-term growth-oriented strategy to compare against a benchmark. Now, why is time period so important? And I'm going to kind of tie this into a business cycle. Is time period, if we're looking from here to here to here, the peaks and troughs are on the business cycles where you want to compare. And ideally, you want to compare from peak to peak. And the reason why is because if you're making a determination of, I want to hold this much in stock, and this much in bonds, and I'm using intrinsic value, and I'm using business cycle dynamics, then that's going to be a fair, how are we doing peak to peak, all right? How are we doing from this peak to this peak? Because if you weren't doing that, and you say, you know what, I'm just going to randomly take a period of time to compare my long-term portfolio. If I'm looking from right here to here, well then of course the stock portfolio is almost always going to outperform. It's like, whoa, I should have been an all stock right here. Like, why not continue to be an all stock? This portfolio from here to here, that's a stock portfolio, has done much better. But in reality is that when it gets to here, and then you have no stock because you said, well, or you have no bonds because the stock portfolio is doing so well. And now we're down to this point. Well, the bond portfolio is going to tremendously outperform. So you got to be fair, you got to look at this and make a determination like, yes, this strategy does work because I understand there's going to be periods of time that stock are going to outperform bonds and periods of time that bonds are going to outperform stock. And then I need the investment analyst or the asset manager to make that determination for me. And also, I don't want to compare two portfolios from just here to right here. I want to compare it because the stock, like I said, is always going to do better. But if we look from here to here, what's going to do best? A stock and bond allocation would do best because you're going to be able to buy so much right here with changing some of your bonds over to stock. So I hope that makes sense. The simple thing to take away from is compare at business once it peaks and troughs. That's the time period that you want to compare it to. Now, I also want to make a couple other points. So we have market timing. Something that's a very common theme I feel from some of the best success and the most successful investors is that they're not timing the market. Nobody knows the turning point for right here. So if someone knew the turning point, you would be 100% stock from right here to exactly right there. And then 100% bonds from right here, risk-free bonds that is, from right here to right here. And you would continue to do that. That, of course, would be the highest rate of return. But nobody knows when this is going to happen. And I'd say the comforting thing is that you don't have to know. You just have to understand the intrinsic value and the time of the market cycle and say, okay, probably going to have some sort of correction here in the next 3-4 years. We don't know when it's going to be, but we do know we're overvalued, so this is not a bad time to hold some bonds. That's where the strategy is going to perform. So no one knows the market timing specifically. Now, if someone says like, whoa, look at how well I did from right here to right perfectly up there, and they want you to compare from right here to there, it's like they're in an all-stock portfolio, they didn't necessarily know that. They kind of got lucky. And then if they were holding 100% stock right there, that's pretty risky to be holding that, and they have to admit that they're getting lucky to that extent. Because what's happened is you have two big things. You have company growth and you have stock price. If we look back the last 3 years, let's say it's from right there to right there, the companies have grown, yes, but the stock price has way outgrown the company. And nobody knows how far the gap between what's intrinsic value and then the stock price is going to keep on getting bigger. So if something's overvalued by 20% because say the company has grown by 20% and then the price is growing by 40%, no one knew that was going to be a 40% return. They just more looked at what's the company growing. So that's how to measure. Those are some key thoughts to think of or when it comes to determining like this is going to be the most appropriate strategy for what I need and the most likely strategy to succeed. So hopefully that's helpful.